Hey everybody, Brian Shannon here from alphatrends.net. It is Saturday, the 20th of June, 2015. Let's look at the numbers here. The markets had a good week for equities. We did lose some ground on Friday. However, the numbers are not adjusted for a dividend, and the S&P 500 paid a dividend of $1.03, so it wasn't actually as bad as it looks where it shows here being down $1.90. So keep that in consideration when you're looking at the market. But again, we had a strong week. If you add that $1.03 back in, it was actually up a little bit more than a percentage point here on the S&P 500. Financials were down a little bit, but they also had a small dividend of 11 cents. And biotechs had a real strong week. That group was up 3.5% for the month after a 3.8% rally this week, and bringing their gains to 24.5% year to date. So just an amazing performance there. And you have to remember, it's the big biotechs, it's not the little ones. There's a lot of mixed messages. If you look at some of the little biotechs, there's a lot of damage in some of those, as there often is in the little biotech stocks. But let's focus on the indexes here, then take a look at some stocks. The S&P 500 did break that downtrend line we had been observing last week, and we are back to this prior important band of what's been support and resistance. We're also right at that rising 5-day moving average. So again, if you consider the fact that we paid a dividend, we are actually closer up to here adjusted for the dividend. So the market is healthy. We had slightly more decliners and advancers on Friday, actually about 1,800 to 1,200, 1,800 decliners and 1,200 advancers. So we did see some pullback, but the longer term trend again still remains healthy. It's in an uptrend. All of the moving averages are stacked above each other, indicating that the buyers are still in control here. You'll continue to hear people talk about reasons why the market has made a top. They're the same people that have been saying that for the last 2 and 3 years. So just listen to the message of the market. That's what's important here. What doesn't matter is all these continued headlines about Greece and about any other thing that they're trying to scare us with. But the fact is, the market climbs a wall of worry, and that's exactly what it's been doing for the last 5-6 years here, and that trend is still intact. Eventually it will come to an end, but it will do so by telling us that by making a pattern of lower highs and lower lows below flat to declining longer term moving averages. And here we see that red is the 50-day moving average, the 100-day moving average is blue, 150 and 200-day are green and black. So we're above all those. They are all rising. That indicates the longer term trend is still higher. We play a strong defense and manage risk on the individual names, and that's what trading is all about. The Nasdaq had a decent week as well. It's right up against these all-time highs here for the Nasdaq 100, the Qs. And again, we've got higher lows, and we've got a band of resistance up here. That band of resistance right now, if we look at the 30-minute time frame, is really 110.75 to 111 really. So we've got this band of support below us. We have a rising 5-day moving average. We broke this little downtrend line. So it looks like the buyers have gotten more aggressive this week and are beginning to take back control. So the Nasdaq was up 1% for the week. Russell 2000 was up 1.4% for the week. So we've seen that 2015 has been a volatile year, but there are still some fantastic individual trading ideas. And the key has been this year, and I think that it is all the time, that you trade what you're trading, meaning that you base your decisions to trade, let's say FireEye or Mobileye, based on what those stocks are doing, not what an index is doing. FireEye broke out 3 weeks ago and has had this massive run higher here, and there are a lot of individual stocks that continue to behave very well. If you buy the stocks at the correct time and manage risk, that's how you make money in the market, and you ignore all the noise of the headlines about what the media tries to tell you is important. What's important is the price action, and price action continues to be bullish overall. There are, of course, stocks that continue to get crushed, stocks that people say were good companies like Rackspace, which gapped down a couple weeks ago and has just continued to get obliterated. Big companies, blue chip companies like Walmart that have had a horrible year this year. You don't buy the stock because you like the company. You buy the stock because maybe you like the company, but it has to be in an uptrend if you want to buy it. Otherwise, you're going to subject yourself to these declines and question what's wrong with the company or what's wrong with the market, whatever. And the market is telling us that there's something wrong with this stock and there's no reason to be a buyer aware of it? Well, it's in this downtrend. Let's go back, I'm sorry, to the Russell 2000 here for a moment. Russell 2000 did break out to all-time highs once again, so this has been the leader throughout this bull market. As we know, this bigger band of resistance from 2014 was broken and then tested just a couple months ago, and now here we are back to all-time highs in the Russell 2000. So last week we said that in these markets there's no evidence of a top, and it's very difficult to be bearish when an index with 2,000 stocks in its components is close to all-time highs. And in fact, now we are at all-time highs. So you want to be a top picker, great. No one has done it yet in this market for the last several years in the Russell 2000. Focus on what your time frame is and managing risk on that time frame, knowing where your stops are. So right now in the Russell 2000, I think next week the key band of support should be found between 126 and 126.50. If it was to pull back to there, I'm sure some people will freak out and panic and tell you it's a bad thing, but it would be a healthy pullback within a primary uptrend, and there would be no damage done to the trend overall. As I've been saying to subscribers day after day, I think the semiconductors are a little bit of a waste of time in here. They had that big run up that failed, and now they just need some time to settle down in here. Overall, though, on the weekly time frame, they're still clearly in a bull market. We've got the pattern of higher highs and higher lows. There's nothing here indicating that a top has been made. Perhaps we're tracing one out. I'm not going to be play guessing games about that. Instead, if it's not clear, then you just avoid it, sit on the sidelines and cash, and wait for things to set up once again. Financials, again, they paid a small dividend this week, and they did sell off though as well on Friday. So they've been choppy, but in an uptrend. We still see this pattern above the rising 50-day moving average of higher highs and higher lows. Now, when we look at the 30-minute time frame, we're back down to what's the important band of support in here. Basically, 24.85 to 25 $5 a share. As long as we continue to hold that, we'll give them the benefit of the doubt in the intermediate term. And longer term, we broke to new highs this week and then pulled back from there. Anytime we see a market make a new high and then pull back, we have to be aware of the possibility that from a failed breakout could come a fast move lower. But there's nothing indicating that yet, as long as we remain above key levels of support. And actually, the bigger level is probably down near 24.50. That no real damage would be done unless we broke below that. So things are still optimistic for equities. The bonds are still in a horrible downtrend. They're maybe starting to show some signs of trying to stabilize in here, but the trend is still clearly lower. As I mention all the time, I don't personally trade bonds, but if you look at the Fibonacci, it came down to the 2/3 retracement of the January 14 low to this year's high, and that's where it appears to be trying to stabilize. The 30-minute time frame, I think that this is going to be an important level for it next week, because it has been this prior band of support. Now we've come down and tested it. We made a higher low. Some of you might say, hey, well, there's a cup and handle, and that's fine. But again, with a declining 50-day moving average, if you get a rally such as this one over here, don't expect them to last too long. Let's take a look at some other stocks. Twitter had an interesting week that it dropped down to all-time lows, not all-time lows, rather, I'm sorry, year lows, and then recovered nicely on Friday. So the stock is still in a primary downtrend. It's going to be volatile. Just keep that in mind. The stocks that I had mentioned last week included Boyd Gaming. Boyd Gaming, if you're an investor, still looks like a great idea. So just be aware of where your stop would go. For an investor, I would say the worst case stop would go down maybe at $14.45. We spoke about General Dynamics last week in Friday's video as well. That had a good week. So manage risk based on your time frame, whatever that may be. But when you have a move like this, it sure would be a shame to allow it to turn into a losing trade. We spoke about Oracle, and this is why I don't buy stocks in front of earnings. I hadn't checked, but I didn't. If I was going to buy the stock and hold it overnight, I would certainly know if the company was reported earnings, because even with what's a good-looking chart, if they have earnings, it's simply not worth the risk to see it gap down the next day like this. Oracle is broken. Don't be involved in that stock right now. Under Armour, we had mentioned as well, that broke this little consolidation, is having a nice follow through. So again, whatever your time frame is, set the stop based on that. I would say, though, don't allow it to turn into a loser if you own this stock. We'd spoken about Western Digital as a downside candidate, and it still looks vulnerable here. We're in a bull market, so that makes short sales difficult, but we've got a stock below a 50, 100, 150, and 200-day moving average, so the path of least resistance is still clearly lower for Western Digital, and be aware, though, of short squeezes in downtrends. This week I had mentioned Johnson & Johnson as a potential short, and I was very clear to subscribers that if it doesn't break down to a new low, then be aware of the possibility that we could see a violent short squeeze, and that's exactly what happened in Johnson & Johnson, that we saw that the stock broke down and then it squeezed those shorts higher. So you have to be very careful with shorts. They are much more difficult than trading the long side, especially when, of course, we're still in a primary bull market. Some stocks I'd say you might want to keep an eye on next week based on whatever your time frame is. This AVGO is been holding on to gains very nicely here. This prior resistance has been tested and held as support. It was up on real big volume, lighter volume, as it's been consolidating the last 3 or 4 weeks. The primary trend is obviously a big bull market. You could argue that it's extended, but at the same time, it's holding on to these gains real well. And if it can get back above this little band of resistance in here, what we're seeing is more repeated tests of that resistance, this little band of resistance. And not only that, we have these higher lows coming into it. So I think if it gets above 144.10-ish type area, it should have the ability to continue to move higher with a stop. I'd say a worst case stop for the way I look at stocks, the worst case stop would go under Friday's low at this point. But depending on your personal time frame, maybe you give it, you trade a smaller share size and keep your stop way down here. That's something I do for subscribers every day when I mention stock ideas. Is I give them swing trade ideas and I'll bring them a couple of different stop levels so that they can decide for themselves where to place a stop. I tend to keep a tight stop. For me personally, I would never let a stop go beyond that on a stock like this. A lot of people would say that's too tight, and I'm not here to tell anyone what to do or argue what's right for most people, but to figure out what's right for you and then manage the risk. But have a consistent strategy for getting involved and have a consistent methodology for initiating the risk based on money management and risk management. So your initial protective stop is your risk management, and your money management being how many shares do you trade, and your continued risk management every single day is to raise your stop up to the appropriate level if it moves in your direction, or to take your small loss and move on, not complain about it, but to learn from it and say, what was wrong with my analysis, or maybe the market fell apart, whatever it may be. CVC is another one that looks set up nicely. Cablevision, they had some news that drove the buyers into it, and stock had a nice run. Now it came up to the 2011 lows, and it's consolidating underneath that, but it's doing so in holding these gains nicely on diminished volume. So perhaps back above last week's high with a worst case stop maybe near 24. That could be a decent opportunity. VRSK is another one that's kind of breaking some resistance here, and now when we look at a 10-minute time frame, we've broken that resistance. So perhaps it's a purchase on strength with a stop underneath 74.75. So to risk 75 cents or 1% on a stock like this could be a good swing trade opportunity. I'd also keep my eye next week on shares of EGHT. You can see that we've got higher lows here. We've got this band of resistance up to about $9.32. And if it can break beyond that level, then perhaps we can push out beyond $10 a share. I don't know anything about what the company does. It's got a cool stock symbol, which means nothing, but it's got liquidity, and if you get involved in it on strength, know where your stop goes. Would it be maybe below last week's pullback low, or maybe near about $9 a share? Either way, it's always up to you to decide. Another one, finally, it would be Lexmark. Lexmark on a weekly time frame, you can see, has broken a little bit of resistance here in the last month or so. After this big rally, it pulled back, digested those gains, and the prior resistance holding as support. Now it's above all the rising moving averages, and maybe getting back above this 46 level it could go. Either way, take a look, and thanks for listening.